we'll be sharing afterwards. All right, and let's get started. So when you're actually looking to fundraise, there's, I mean, definitely sort of like the mainstream, mainstream notion, or sort of the more popular sort of avenue has been, doing it through equity. Obviously, giving away piece of your company, your shares in your company for, for capital. Basically, whether it's someone taking a board seat, whether it's someone joining your company early on, etc. Equity seems to be sort of like the main investment vehicle, or sort of the most talked about vehicle out of all. But part of this presentation will focus on saying, hey, there's other instruments that you should be wary of in your toolkit. But starting off with equity, one of the key sort of questions when you're going round by round is you're trying to understand what lessons you've learned from the earlier rounds or the earlier sort of experiences that you've already had, whether it's with friends and family, whether it's with angel groups, early stage investors, etc. What went wrong? What went right? Did it take too long with some investors? Are you trying to see if there's any behaviors with regards to them kicking tires? They're trying to peer into a little bit too much information. Are they trying to get access to things, or are they trying to throw sort of terms and conditions at you that are a little bit too oppressive or draconian, which I remember seeing with a few sort of term sheets with a couple of angel groups way back when. The other thing is to actually ask, when's kind of the best time? Obviously with COVID, it's become, it's become a little bit more sort of chaotic. Usually it used to be anything that was sort of pre-summer and everything that is sort of pre-Thanksgiving, sort of like the beginning week of December. So right now we're literally right at the tail end year when you're actually looking to fundraise. So if you have any conversations now, best to kind of wrap them up or kick them off into the next, or kick them over into the new year, as deals generally don't end up sort of closing during this time period. The two key questions that I kind of want to cover here is how do you qualify new potential investors, and what are investors looking for this time around? So going over, these are more or less arbitrary numbers, but this is sort of just a high level of what seed and Series A looks like, just to kind of keep in mind what kind of dilution you're having in each round and what kind of traction and what kind of different players are going to have. But this should be fairly obvious to some of the founders here, where it's, you're going and you're trying to build that initial lead list of investors going into your post-seed A, sorry. You're trying to look at the different stages. You're trying to look at, where do they typically invest? Do they have a focus on, specific provinces? Are they Canada-wide? Are they North America-wide? Or are they sort of like geographically agnostic? Sectors and size, obviously. The first four categories on the slide are pretty much self-explanatory, I would say. The most two important ones on this entire slide, and these are the key takeaways that I want you as founders to know, are vintage and activity. I think these are the most important ones. Vintage being, is this fund still actively making investment? Do they still have that dry powder to actually make new investment checks? Or have they gone into sort of reserve and follow-on funding mode? That's definitely something that you should be asking either the portfolio companies of the investors that you're looking after, or you're looking to kind of go after, or the investors themselves, trying to understand how old these funds actually are and if they're actually gearing up to raise new funds. Quick caveat here as well is, if they're raising a new fund, there might be a chance that, yes, they are looking for new deals, but you might be warehoused. And you might be just sort of lined up as pipeline, which then they'll use to kind of go for LPs and kind of show that, hey, we have a healthy pipeline, help us close that fund. So you might be stuck in a little bit of, like a waiting room at that point. But vintage is very, very key for you to understand where they are at in terms of the cycle. Activity is the other one. Two key points here: how active they've been in the ecosystem. So like, was the last check they wrote 6 months ago? Was it 6 years ago? Is the website still up? Are they still sort of active, or have they just gone into sort of like fund management and basically portfolio management, sorry. And another key thing is, have they invested in competitive companies? So competitive companies is something that we'll touch upon as well in data rooms, but I've had this happen in the past as the previous investor relations manager at the DMZ, where I was helping a company raise like a large seed, like a healthy, I think it was like a 1.2 or 1.6 million seed. Um, one of the VCs that we were talking to here in Toronto actually had investments in a competitive portfolio. How do you manage that? It's something that you really should watch out for. Understand that the VC has shares and an equity stake in that competitive company first and foremost. Has not put a single cent in your company just yet, and is basically more pro the other company first, and will put them ahead of anything else until you actually sign a shareholders agreement, until the money is wired into your account, basically. It's just things to watch out for. So when you're going into due diligence, when you're talking about data room, when you're talking about sharing any information, this is something you should be very, very wary of. But yeah, key takeaway from this slide, last two categories are probably the most important ones that you should constantly be researching. Oops. There we go. This is literally just how you do the sales funneling for or how you do the funnel building for investors. You're in the accelerator at the DMZ. You've probably seen the funnel so many different times about qualifying, contact, meeting, and closing. But basically, yes, you're trying to identify the relevant investors, right? And when we're talking about introductions, which we'll cover in the next slide, that is also key. I will also share with you a few tips and tricks that I've actually learned when I used to reach out for investors on behalf of startups at the DMZ, and when I actually still reach out to investors today. Meetings and what happens post meetings is actually super important. And then using the lead, obviously, to sort of like use that as the momentum actually to close the round. Quick question down here, which usually kind of happens, or which I come across actually from a lot of founders, is how long is this going to take me? Most of the time, you're looking at, I think, like the more mature the round, the longer it actually tends to take. So Series A, from what I've seen, is 6 to 12 months, can be 6 to 12 months. I've seen them close a lot faster. I've seen 3 to 6. I've seen sort of a little bit of both flavors, but it really does depend on how fast founders tend to work and how open your data rooms are and how open the due diligence and how fast the due diligence process seems to work on both sides, actually. So it's not sort of like this is a founder fault, this is a funder fault. It really is like how open the channels are between one another and how sort of communicative you can be with one another and how fast you can provide the information and share the information with one another. So openness, transparency, and communication probably is key to actually speed up that process, as well as obviously if you've got momentum, if you've got more and more sort of funders sort of ready to jump into the round as well. This is something that I guess a lot of founders need to deal with, which is the no, or which is we're passing on the investment at this point. No, they're not horrible human beings for saying, we're not giving you the check at this time. There obviously, there are a lot of reasons that actually go into a VC saying, no, we're passing on an investment. Timing, I can't explain how critical this one is. And this was actually something that I experienced myself when I was with Scale Up Ventures. There was an investment opportunity for us with a company in Ottawa. Was just honestly ticked all the right boxes. Was just an amazing sort of opportunity for us. I remember, spending hours and days and weeks writing the investment memo. 60 pages long, lots and lots and lots of due diligence with customers and their team, etc. And eventually we ended up passing on them simply because of timing. It wasn't working out in terms of how we wanted to deploy the fund in that company versus another company as well. And it wasn't a competitive investment. It wasn't lack of fit. It wasn't because of existing capital gaps or market or traction or anything like that. It simply came down to we needed to make the investment in another opportunity first and then maybe come back and visit this one. And we just didn't want to hold up the potential opportunity. It literally was a matter of timing. And that is actually a very critical sort of like a very critical point sometimes that, I'm not sure how well VCs can actually communicate this to you, but this is something that you should kind of keep in mind. Fit, obviously, this goes back to qualification. I believe this would kind of fall squarely on sort of like the founder where, it is your role, it is your duty to kind of just, really sort of look at the different sort of investors and understand the fit. understand really where they're trying to invest, try to get a sense of where they're investing and what their thesis actually is. Traction, market, etc. That's something else. I mean, you'll see it. It's in the appendix slides. You'll see something about slopes and sort of steepness of slope and market opportunity. If the market's just not growing, if there's not a lot of sort of like buying power, if there's not a lot of sort of potential to kind of grow and scale, then that's something they're not really interested in. Because at the end of the day, and Reza can tell you this, there is an ROI. There has to be an ROI, and they have to generate that that return on investment from you. And if you're not going to grow as fast, and if you're not operating in a market that's moving at high velocity and has that deep well, then that's just something that they're not really going to look at. Competitive investment is something that we just touched upon earlier, where they might be courteous and let you know that, hey, we've got a competitive investment, so probably not best for us to kind of continue with the conversation. Be very wary though. Some VCs, some angel groups, some angel investors probably might take the chance here and not tell you about this, and kind of use this as sort of competitive info gathering. Be careful, please be careful. Do your research, look at their portfolio companies, and try to find their portfolios even if they're not listed on their websites. Try to get a sense of who is in that portfolio. Talk to your peers, talk to the DMZ, talk to Reza, talk to Emily, and try to get a sense that if they've made similar investments in the past, if you're able to kind of pull it up from Crunchbase or from any of the other databases. Key takeaway here is, when you're reaching out to investors, do a lot of A/B testing in your communications. Try to learn and understand why they're telling you no, why they're passing on this opportunity, and try to improve. Is it in your messaging? Is it in the pitch deck? Is it in the offering? Is it just because the way you've positioned the market doesn't make it seem as attractive? Is it in the business model? Is it something that you need to reflect on and improve? This is basically your chance that, this is a learning opportunity, really. And I know it sounds cliche, but this was something that we really tried to do at Scale Up when we would sit down with founders and tell them why we're passing. Try to also at least get that answer, like a full, detailed answer from VCs as to why you're, hey, why are you passing on this opportunity? Could you give me some helpful hints? Could you point me in some, really good directions as to, other people to talk, etc.
Yeah, I think the point, sorry, late to jump in here, but I think the point about asking for feedback is like incredibly important. And there's a couple of reasons, and I want to bring up two other things that maybe I want to highlight here in that slide. Asking for that feedback goes into Late's point at the bottom there, where you're testing by going out and pitching, right? But if they're not going a certain way, or you've gone through maybe 3 or 4 meetings, haven't got the same feedback, not hitting, trying to understand why things aren't hitting, learn, improve your pitch, and then restart again. We've seen several pitfalls with founders where they have this long list of qualified leads and they've blown through them. They've gone, 40, 50, 60, 70 meetings, trying the same pitch, same deck, getting the same answer. And the problem is afterwards they change their whole deck, change their pitch, and now they're all ready to go again, but you've just blown your whole lead list. And to get back another meeting is much more difficult. So that whole point at the bottom of test, learn, improve is incredibly important, and doing that very iteratively. And you guys all being founders of your companies know that in your own product and how you guys are building your company. It's the same with fundraising. There's 2 other points that I wanted to bring onto this. Cap table management early on in the game is really important. And I bring that in sometimes when founders are running really low on cash or started the fundraising way too late. We all have a tendency to really need that cash now. For instance, I'm working with one company that they've already basically got, almost given away 49% or 51% of the company to early angels and investors. And the problem is that really doesn't set you up for long-term growth or VCs to even come in, because you've already have a big shareholder. So I think learning some best practices and doing some methodology and strategy around your fundraising early on will really set yourself up for successful fundraising also.
Yeah, and honestly, again, I'm just going to use this to kind of highlight the PIR hours. So if you want to talk about sort of like, how do you reach out to investors, doing cold emails, or generating warm leads, or how do you get warm leads or warm intros into them? Happy to talk to you about this. Again, this was literally my job for 3 years at the DMZ. where I helped sort of facilitate a lot of different connections and helped get some companies funded. So next question is, you've had, let's say you've had those meetings, you've reached out to, the right investors, you've qualified the right ones. You've had all these successful sort of like pitching meetings with them. They loved it, ticked all the right boxes. Now they're asking for a data room. What now? So there's 3 different things that kind of go into the data room, where you're kind of focusing on your financial data, your organizational structure, and your revenue data. This can differ between sort of like a lender, what a lender looks for in the data room. Now, this is a sort of like a good segue to bring in Graham towards the tail end of this specific topic, and from an equity perspective. On the venture capital side, it's very, very sort of kept simple. What you kind of have, what you kind of need in there is essentially like your financial data, organizational data, anything on IPs or anything that's like outstanding loans or obligations, that type of thing. From scale up, from my time at Scale Up, what we used to look for was, what was your business model? Can you include a list of your customers? Can you introduce us to some customers so that we can actually call them and ask them? And then we would have some team interviews just to figure out, what the team dynamics used to look like, if there were any sort of like problems in the team that could potentially happen down the line, et cetera, that sort of thing. But it's very much run of the mill. It was very much, this slide pretty much covers what should go in the data room. But the most important key question here on this slide that I kind of want to draw attention to is, can you have a single data room? Can I do a one-size-fits-all data room? Because you're obviously going to speak or be speaking with multiple investors at this point. And the answer is yes and no, depending on how complex and how sort of security focused you plan on being. We get it. We get it. It's a lot easier to have a single data room, but it also can become a lot more complex and a lot more harder to kind of keep track as time goes on. You will start to notice that, trying to control who is in there and who sees what, especially if they can actually see one another. That's actually something that you do not want. And if you can control for that, you should probably have that as your top priority. It's just going to get a lot messier, sort of like as your round sort of goes on, and as your round starts to fill up, as you start to filter out different investors, as you start to add newer documents that are requested by one investor versus documents that are not requested by another. There's a lot of sharing permissions that you're going to have to keep track of. So, single data room, sure, but it's going to come with its own fair share of work. And the last thing you'd want is, investors figuring out who the other viewers are in this scenario. Again, I've had situations in the past where a founder, you had like 2 investors within like the round of you had 2 investors pretty much figure each other out, find out who the other one was, essentially met, and then decided that, we're going to strong arm the founder into a specifically lower valuation. So the founder comes into a second meeting with that one VC that he was having really positive meetings with. The attitude was completely different. The nuances were different. The terms were completely different. They knew each other now. They knew exactly what they wanted out of this deal. And the strong arming began. And that founder at that point had exhausted most of their contacts anyway, had to take that deal. And it was not ideal. Just something to keep in mind with regards to sort of information sharing, and if you want to have one size fits all, if you want to have it sort of more convenient there. I will use this as a great segue to kind of bring in Graham to kind of talk about the lender perspective for the data room, and then he will walk you through sort of the lending perspective on the fundraising.
Perfect. Thanks, Laith. You're still going to flip the slides here. First, I just want to let everyone know that obviously now you've heard how easy raising equity is. I can't wait to tell you how easy debt is. So quick as it relates to data room, just to close this item out. Won't surprise you here that what lenders are looking for is along the same lines as what equity investors are looking for. The perspective and how we review the materials may be a little different. For some context, I work on the tech banking team, so I work daily with founders their CFOs or VP finances to kind of help evaluate opportunities, whether they be debt or otherwise. And our perspective, one, oftentimes is, who are your equity investors? Do they, they're going to peel the onion back further than we will. They're going to get to understand the tech, the market, the strategy at a much, much deeper level than we are. So we have the ability to kind of piggyback often on the strength of diligence that was completed by these individual investors. So I'll nod my head and say that this list also is the type of thing that you should expect from lenders. The good news is because we're often piggybacking or coming shortly after an equity round, all of this stuff is going to be at hand. So it's extraordinarily rare that there's incremental needs when it comes to the lender diligence requirements. And most often it's sort of hit forward on stuff you've already shared with the equity investors and or shared the existing data room, particularly for early stage companies. I just saw Sweeney put a note in the chat, sort of throw questions up there. She said none are rudimentary or silly. I, for one, love silly questions, so please throw them out there. I also note that she did say that she didn't mention anything about hard questions, so you're welcome to keep your hard questions to yourself. We like to keep this nice and cruisy. Totally kidding, of course. Okay. Let's jump into debt. I've got like 15 minutes to give you an elevated understanding of debt for early stage tech financing, so tech companies. So obviously, going to go pretty quick. There's both a Q&A and some scenarios at the end that are going to be collaborative, so we'll come back to that in one quick sec. So obviously, the reasons why founders are stoked on debt is it's less dilutive compared with equity. And I think that one of the overarching themes is it's about balance. All equity and no debt, you're not going to be using capital efficiently. Too much debt and no equity, and you could end up over leverage, which has a whole bunch of different risks. So the answer is always going to be some balance here. And I think that everything that I'm going to talk about here, both this slide and beyond, comes with a slew of asterisks and grains of salt, because it always depends on the given circumstance, the company, the lender, the form of debt. So take these as broad strokes guidance, and I think I'll echo what Laith said, is we're happy to hop on sort of separate discussions to get in more detail about your specific use case, and then circle back at the end of this. Okay, so how to think about debt. First, it's important to recognize that there's different types of capital, obviously equity and debt, and they play different roles. It's the exact same thing with debt. There's different types of facilities to play different roles depending on the life cycle and need of the business. Part of this, and this is sort of an overarching theme, which we'll touch on a couple of times here, is it's important for founders to understand the difference between what is equity risk and what is debt risk. There's going to be some gray area, and SVB has the luxury of kind of playing in that gray area. But I think it's important to understand what risk tolerances different type of capital have, so that you can not be spinning your tires pursuing something which maybe isn't the right fit. So this chart, the intention really is just to be a high-level example of how different types of debt can come into the fold at different stages of your business. These boxes can shuffle all over the place, but this is kind of a good visual representation of the different stages. So first, let's talk about the first box, which is going to be the most relevant here. And I'm going to get into the first two, both venture debt and credit lines, a little bit later. So venture debt, which is a term which is thrown around quite a bit, but broadly speaking, it's debt that supports early stage companies and is typically complementing institutional venture capital rounds. So the venture element is kind of triggering this early stage and kind of partnership and kind of augmentation of a VC round. This is relevant because in most cases, and certainly in the context of SVB, when we're providing venture debt, who the investor is the cornerstone of our underwriting, our risk underwriting approach. It's important. It means that we can do different things depending on who the investors are. So for venture debt, again, early stage, who the investor is really matters. Again, I'm going to unpack that a little bit more in a sec. Credit lines. So venture debt's relevant because if the investor matters, it's burning cash, pre-revenue. Cool. We have a lot more leeway there. Cool. No problem. Just go for it. Credit lines, obviously, in order to get access to a credit line, there needs to be things to lend against. So that might be revenue. Recurring revenue lines are obviously something that are talked quite a bit about. It could be balance sheet. Maybe you've got accounts receivable, you've got inventory, maybe you've got shred. In all cases, there's something that a lender can underwrite to for the purpose of repayment. So that's why it's sort of slightly later stage, because you need to start seeing these first elements of traction showing up. Growth loans, super generic term, really just referring to term loans, which are supporting company on the basis of the business's track record. Usually it's EBITDA. Sometimes you can see larger MRR facilities, or just sort of very, very strong top line. So again, these are companies that are starting to enter into scale mode. The only corporate finance and biofinance will sort of kick that can down the road. That's big stuff, kind of think 100 million top line companies, IPOs, buying buyouts for acquisition. The piece which is relevant here and it dips down lower is mezz financing. Mezzanine financing is a form of subordinated lending. I'm going to talk about junior senior debt in just one sec because it's a relevant concept, particularly for early stage founders. Mezz financing specifically, you hear this term thrown around, it is primarily used as a bridge to a very clear outcome. So you're going to get a big whack of capital. It's going to be the most expensive debt you've ever taken in your life. And it's going to help get you optimally positioned before big equity round, IPO, acquisition. You're basically going to use this to like drive that last 6-12 months of growth before you get to that inflection point. You can see it dips down earlier because depending on where you're at in terms of your vertical business life, what you want to do with the business, it can play a role earlier than you might see some of these larger facilities. So before we sort of get into venture debt and into credit lines, it is an important concept to understand the difference between junior and senior debt. SVB, the B is real, we're a bank. All other banks are senior lenders. We need senior security on your assets to lend. The good news is that allows, we're more risk averse than private lenders, but the good news is that allows us to lend much cheaper. So our interest rates and cost of capital are much lower than private lenders and other junior lenders. What this junior subordinated lending means is that they are willing to take a second position on the assets of the business of a corporate lien, so they're taking a riskier position, but their capital is more expensive. This is when you're going to see capital in the teens. In many cases, this is relevant because if you're in an early stage business, you may end up with, there's a lot of lenders in Canada who are fantastic at supporting early stage businesses, sort of between seed and Series A, let's say. If they're high interest rate lenders, it's very common when you get to a Series A or beyond, that capital, that debt may stay there, but they'll subordinate to a senior lender like SVB coming in. So it doesn't mean that they just go away, but it is important to note, if you have debt on your balance sheet right now that's in the teens percentage, that should be a lender who will either, one, get refinanced when you kind of do additional capital raises, or two, be willing to subordinate to that senior lender. An important concept, I think. Like, if you want to flip, I'm going to do a quick overview of venture debt, and I'm also going to do a quick overview of credit lines just for everyone's benefit. Kind of the two most likely sources of debt in the early stage. As I said, venture debt means a lot of different things to a lot of different people. It's thrown around left, right, and center. I'll tell you what it means for SVB. And for us, again, SVB pioneered venture debt, over 30 years ago. It's kind of one of the earliest things that SVB did when it was first founded and working with tech and innovation companies. And it's specifically meant to, again, complement these institutional venture rounds by providing extremely flexible runway extension. That's like the most plain vanilla way to view it. So facility type, as I said, amortizing term loan. So the idea is this is a term loan. So typically it's going to, an SVB structure would be a year to draw the facility. You just raise an equity round, you got a bunch of cash on your balance sheet. Like, I don't need debt. Agreed. But you want to secure it from a position of strength. You just raise that round, you got a lot of cash, lock it in, get it committed, and then you have a year to draw on it. Whatever's drawn after that year, then it amortizes. And I'll tell you the relevance there is most of the scenarios, when you go to raise your next equity round, SVB, for example, would refinance that term loan so the cash never really hits your balance. It never sort of draws down on the balance sheet. We're just kind of kicking the can down the road to such a point where the business is mature enough to be able to service that debt. I'm going to go through this real quick and we got for Q&A at the end, but sizing, the way to think of it is 20 to 30% of an equity round. So average 25%. So you raise a $10 million round, $2.5 million venture term loan, reasonable sizing. That is also a good proxy for how much senior debt you should expect relative to equity. Debt equity ratios are relevant. You raise a $10 million round and you want $10 million of debt. One, either you're very ambitious in your expectations, or two, that's not going to all be senior debt. It's going to be very expensive. The sizing we use it for generally is 3 to 6 months of additional runway. Usually it shakes out to about 6. So the mentality is, what could you do with another 6 months before you had to go raise your equity round? What valuation inflection point can you get? It's kind of like the overall thesis. Cost, there's 3 primary components. Interest rate, obviously. An upfront fee. As I mentioned on venture term loans, at least SUVs, you don't need to draw it for up to a year. And frankly, you don't even need to draw it at all. An SUV is fully committing that capital. It's 100% allocated to you, so it's committed. If you choose not to draw it, there needs to be some cost or fee associated for making that commitment totally available for you. So that's where the upfront or the commitment fee comes into play, and it's an important part of the economics. Warrants. Warrants are a very, I'm sure we're going to talk about this after, but warrants are always an important piece of discussion. Early stage businesses are higher risk, fundamentally. If we're looking to underwrite to the strength of the investor, so we're literally looking to that equity investor, we're taking equity-like risk. Additionally, you'll see in the next one, there's no financial covenants. Most debt is governed by covenants. So we're saying no covenants, hyper flexible, draw it when you want, use it for what you want. We're looking at that strength of investor. We're saying, we know you got their back, we trust your thesis. That's kind of the idea. So we're taking this equity-like risk. So there needs to be some kind of equity-like upside, which again, senior lenders typically aren't getting exposed to. The thing to keep in mind is that then puts SUV and the lender on the same side of the table as the founders and as the investors. So we all have the exact same outcome in mind. This affords a ton of flexibility in the event you hit a hiccup, or that you need additional support, or you're growing fast and need more capital. That alignment is incredibly powerful.
Are there any standards or anything for the warrants, or any things that people should think about with those?
Yeah. Yep. In terms of, I'll give you a general rule for Series A and beyond. And again, take this with a grain of salt because every circumstance is different. Assuming you just closed a round, you're in a very liquid position, you can assume warrants would be in the neighborhood of 20 to 30% on a fully diluted ownership basis. 20 to 30% of fully diluted ownership. If it's a riskier transaction, if it's an early, like occasionally SUV will do seed deals, it's very uncommon, the warrant is higher because it's higher risk. If it's looking more like a bridge loan, warrants are going to be higher. But the plain vanilla is sort of this like 20 to 30 basis points on a fully diluted ownership. The thing to keep in mind is the intention is not to exercise those warrants and just be an equity investor. The intention is they get exercised when there's an IPO or an exit. So it's this, everyone's working hard towards the same outcome. No one harder than the founders, of course, but SUV sort of is going to do its best to pull its weight, open doors, provide relationships to sort of support that growth trajectory. And when there's that positive outcome, there's the ability for parties to participate. Does that help, Reza?
Yeah, that's great. Thank you.
So in the interest of time, I'm going to quickly go to the lines of credit. These are the less sexy, but quite helpful sources of capital that I've talked about a lot. Again, in order for this to work, you're going to need something for a lender to point to. Having an institutional investor really helps too. It's going to give us as a lender more flexibility because we know that there's a strong balance sheet, there's strong investor support, there's access to capital. All of this is going to provide lenders with comfort that a line of credit is not going to be used for runway extension or as like the last dollars in the business. It's really going to be used for its prime need, which is working capital. So this is venture term loan, longer term. It's meant to sort of drive growth and support that longer term vision. Lines of credit are generally going to be smoothing out working capital cycles. So the general facility type, revolving line of credit. Typically 1 to 2 year terms. And again, the idea is it's like your credit card or your personal line of credit is you draw on it, you pay it down, you get to draw on it again. Easy peasy. In terms of sizing, it depends on the collateral. I'll give you some reference points if it's helpful. Accounts receivable, so you got AR on your balance sheet. Typically you can assume about 80% of accounts receivable, eligible accounts receivable, you could use for the availability in a line of credit. So if you carry, let's just say $1 million of accounts receivable, you could have an $800,000 of availability under your line of credit. In the same respect, shred, which is really another form of an accounts receivable, you can include that in the borrowing base as well. SUV will lend up to 50% on accrued shred, and 80% on submitted shred. So you kind of get credit for it throughout the year. Inventory is tricky. SE will typically lend, and this is true of most lenders, 50% of net liquidation value, which is important. Inventory, which is IP rich, is way harder to lend against. If you have off the shelf stuff that you can sell on a market, if you sell a commoditized product, okay, that's easier because the market's established. There's less liquidation risk. So inventory is, there's very few occasions where you're leading with your inventory as your collateral because you're just not getting a lot of lift out of it. And then validating the strength of collateral through audits is very expensive and timely. The last I'll just point to is recurring revenue lines. 3x to 6x monthly recurring revenue is the general range for senior lenders. Yes, you can go higher if you get junior lenders. There are certain scenarios where senior lenders will go higher, but 3 to 6x is common. I will tell you, as COVID definitely gave people a little bit more pause here, where those who leaned way over their skis got over the end in terms of multiples. And then COVID slowed that MRR. You had lines which were too big for the relative growth. Companies have to pay that back down. Costs, all the same stuff, no warrants, because it's got a covenant, so it's sort of governed in another way. But there's also a standby fee, usually, or an unused fee. So basically, again, all of the, let's say $1 million is committed. If you're only going to use 200,000, that 800,000 is still available for you tomorrow. So there's sort of an undrawn or unused fee portion, commonly. Covenants. So as I mentioned on venture term loans, the intention is to remove the financial covenants so you can focus on growing the business. You don't want to manage your business to covenants. You want to manage it the way you need to manage it. Under lines of credit, this is still true. And again, our flexibility is going to be there more so when there is a strong institutional investor, but you're going to start seeing covenants because we're relying on the strength of that collateral in order to lend and to revolve. So it's going to be like an asset quick ratio is basically cash versus debt. RML is remaining months of liquidity. Basically, how much runway do you have? A P&L test might be EBITDA. Even if it's negative, we want to sort of see like, hey, you got to hold your burn within a certain range so that you don't get into a situation where, again, the last dollars in the business are this fully extended line of credit, which is a sort of a very uncomfortable situation for lenders to be. The thing I'll flag here is if you're talking to lenders and they point to RML or minimum cash balances, you're getting very close to having a cash-backed loan. Scratch your head and think, is this providing me with additional value? If it's cash-backed anyways, is it incrementally beneficial? So it's something to sort of keep in mind. That was a power session. I think, Liz, do you want to switch slides? Because we've got 3 scenarios I wanted to highlight, and hopefully this is going to be interactive. I'm very conscious we're not going to have time to go through the 3 of them. So why don't we go through the first 2, because I think they're probably going to be the most relevant here. So what I wanted to do is sort out what are some realistic scenarios you might come across? What are sort of the financing needs? So this was the Grow Baby Grow scenario. The snapshot, it's an AI-enabled process optimization SaaS company for manufacturing sector. So generic company. They're doing 150,000 of MRR. They've got 1 primary commercial contract and a whole bunch of little proof of concepts. So kind of getting some traction to relatively early days. They just closed their $10 million Series A led by Bessemer. Easy peasy. They now have 20 months of runway, which includes growing the team a little bit. Now their goal is they want to get to a $3 to $5 million ARR revenue run rate and get, how many did I put? 2 to 3 more, 3 to 4 more beachhead logos before they raise their Series B. So what should they do? They've got $10 million sitting in the bank account. Should they do anything with financing or not? And I will open the door. If anyone wants to throw a guess either in the chat, do nothing, line of credit, raise more equity. I'll do it for 3 seconds just in the interest of time. I know we're getting tight here. The hint is you should think about venture term loans. Because again, if you fast forward and it's 15 months from now and you're not quite there, it's like, oh man, that's going to be hard capital to raise. If you secure the capital now, you're going to be able to use it if and when you need it. It was a bit of a gimme. And yes, a bit of a plug for SUB. Leith, you want to sort of switch and we're going to kind of play out a slightly different situation. Scenario 2. So close and yet so far. Same company, except now they've got 75,000 MRR through a handful of small proof of concepts. But they're really close on signing that first fully commercial contract for another 75,000 MRR. They raised their seed round 18 months ago, but they only have 5 months of runway. If they go out to the equity market before signing that commercial contract and getting that ARR bump, it's going to be tough. They're going to definitely take a valuation hit. Maybe they're not even going to be able to raise the round. So what their goal is to get that contract signed, get MRR over that $100,000 mark before going to the market to raise equity. Now what do you do? What are your options? This is the harder one. And I don't know if people go off mute or just throw it in the chat if you have an idea, but this is a really tricky, rather common situation. I can't see people typing. Reza, you guess.
Yeah, I was like, funny enough, I've kind of heard this similar situation from a few founders I'm talking to right now, which is it's a scary one, right? And that's a lot of people start panicking, and this is where all the don'ts that we mentioned, they all start coming about.
It's tough, and Laith, what do you got?
No, I was just gonna say, like, this is one of those things where immediately, if you try to go equity, you will take that hit, especially if they figure out that you have the 5 months of runway left, depending on what type of investor you end up chatting with. That's, it could play out very unfavorably for you. I'm not trying to like make the situation any scary. I'm just telling you literally what I've seen. And funny enough, I think Paul Graham even talks about like a whole scenario where you've got so many months of runway left, and you now are basically forced to go down the equity route if you don't actually end up doing any of the alternatives.
Yeah, so I think on my side, I think I would think about venture debt as an opportunity to go down. That would be.
So I'm gonna. So there's no right answer, of course, because this is an extremely challenging situation to be in, and it's very uncomfortable. And I'm gonna give you my 2 cents personally, and then I know that we don't have a ton of time for Q&A, so we can go back and revisit this if it's helpful. Is this equity risk or is this debt risk? This goes back to that original point, like, what's the risk profile of your business right now? This is not senior debt risk. You have 5 months of runway left. If you don't hit that milestone, you can't raise equity. That's a really challenging situation for a senior lender to be in, including SVB. And again, we were sort of active in this space. This is a really tough situation. You want to defer that valuation discussion because you're not there yet. Okay. So the list of options are maybe convertible debt. You're going to get a convertible note. It's going to be expensive. It's going to be a discount to the next round, but you defer the valuation. You don't anchor yourself to a premature valuation. Okay. By expensive, I mean, it's probably going to have a teens interest rate. It's going to have probably a 20% discount to the next round, things like that. But it's going to get you there with avoiding that. Most of the time, if you've already done a priced round, safes are not common. Usually safes are before you do your first price round. So convertible debt is the more structured, the more expensive, bigger brother. The alternative is insiders just give you a seed extension. Hopefully they give you a bump in valuation, just a little bit, but you kind of bill it as a seed extension. And you just get just as little as possible to make sure you get to that milestone. The other piece is, do you start raising your Series A? Do you go to market when you know you're almost here? It's tough because, as Laith said, it's going to take you some time to close that round. The reality is, at this point, you probably want to be warming up the funnel that Laith had mentioned. You want to have those contacts warm. You want to get an understanding of like, how interested are they? When are they thinking of their timing? What are their fund dynamics? You want to have that warm because it's not going to take you 3 months to go from start to finish. You're going to need to start those conversations soon. So no easy answer and no cheap answer. If you find yourself in this situation, the answer is going to be expensive or really, really stressful. This is unintentionally a pitch for the value of securing capital up front. So if you end up raising your Series A, you fast forward 18 months and you end up in the same situation, that could have been a more solvable situation with like a venture term loan that was secured alongside an equity raise. Where you have access to that then. That gives you that runway extension. You secured it from a position of strength. Raising from a position of weakness is really hard.
Yeah. I think that was a great way to kind of wrap this session up in terms of the case study. You know, a lot of founders say raising capital is a full-time job, which it absolutely can be and is. But I think the earlier you start this process, when you're 12 months out and starting to reach out to investors and having those early conversations, it doesn't have to be a full-time job. The closer you get to that 3, 4, 5 month runway mark, and now you're in a stressful position, that is your only job at that point, which is just trying to secure the future of your company. So you can take a lot of the burden off yourself by just being proactive in this. So we have a good question in the chat actually from Yulia here. So I'll read it out, and then if we can have a couple minutes quickly to go on this. If there's any other questions, hit them up in the chat or come off mute. So here, this was part of Laith's earlier point. Speaking about competitors in the portfolio of a VC, is it always a bad idea to reach out to this type of investor, or is there room for synergy for a competitor? And there's maybe portfolio diversification that the investor may like. So Laith, I have my own comments, but I'll kick it over to you guys, or both of you.
Yeah, sure. I mean, that is a good question. So is it always a bad idea? No. But I would not, I wouldn't prioritize, like basically I think it goes back to the sort of like let me just try to go back to the slides. Like it just goes back to the qualification of the different investors that you're trying to speak with. At this point, after you've built that list of sort of qualified leads, they would probably not be in your top priority. I would not put them as like, these are the people that I really want to raise sort of capital from. There is a wariness to have from there. Like even if you do see some synergy in there, you have to understand that like if they, if you end up sharing so much information and then they end up saying no, you don't know if they're going to share that information with said portfolio company or not because they have an equity stake in that company. It's just something to be wary of. It's something to be, when you're actually prioritizing, who this, when you're building a round, you're like, ideally, I want X, Y, and Z VCs to be part of the round. That investor would probably, or should not be probably one of those 3 investors that ideally you want in that round, or 5 investors or 6 investors, or how many investors you're actually going after. They would probably be secondary. Just be careful. Is it always a bad idea? Not really. Is there, there is room for synergy with the competitor? Probably. I mean, if you actually go in and you're doing your due diligence on the investor, which you should be, and then you find this company, this would be a company that you would probably start investigating yourselves, try to understand, like, is this an actual competitor or are they operating in an adjacent sort of like field? If they are operating in an adjacent field or maybe upstream or downstream from you, how would you actually play off one another? How would you actually work with one another? And those would be some really good questions that you could probably ask that VC. But again, be careful, be wary of it, and don't share information unless you have to. Don't just willingly share everything. Understand that that investor has a stake in the competitor first and foremost until there is money from that investor in your bank account and until they are also on your cap table and they have an equity stake in you as well. So just keep that in mind.
Yeah, I think you summed it up really well. I think, Yulia, just think about it's also, they may be really qualified because they like that space, but the likelihood of them investing in a competitor is very low. So, you want to balance your time as well. I think we're just up to time, but if there's I think that's it. Sweeney, cut it off.
Yes.
Any advice for pre-revenue companies? I saw something about pre-revenue companies.
Yeah, someone just jumped in with like a last minute question.
Maybe that could be our final comment.
All right. So does anyone have advice for pre-revenue companies? My issue is that we still have a lot of programming development to complete before we can start generating revenue. But when we start generating revenue, we will not need an investor as much as we do now. Companies bootstrapped at this point. Most investors I talked to told me they would take a look once they're generating $1 million a year in ARR.
Okay, so qualify better investors. The investors you're speaking to are not early stage, or at least they say they're early stage on the tin, but it's not really early stage. Look for pre-revenue investors. Look at other forms of funding. Typically, I'd say grant programs, non-dilutive funding sources, etc. There's lots of those, like a lot. And yes, so pretty much like on the slide, you need to qualify sort of more investors on the earlier side.
The only thing I'd add is if you're pre-revenue and you're a business which is predicated on the success of your commercial strategy, get some MVP revenue, proof of concept, anything you can to prove commercial traction. If your business is building like deep tech, IP rich stuff, have a very dialed IP story and make sure you're telling it to investors who care about an IP story. That's the only two things I'd add. I know over time.
Non-dilutive. This is probably a good example of where shred can take place as well. So,
yeah.
Thank you so much. It was a great conversation. Thank you, Reza, for speaking from your experience. Laith and Graham, thank you so much. I know the founders are very thankful as well. Once again, I dropped my email in the chat box. If you want to meet one-on-one with SVB, please reach out to me. I can help you book that meeting. And if you are on the DMZ Slack channel, you can Slack me there. They're also on the portal, and you can book a Calendly meeting. So thank you, everyone, for your time. And as promised, we will be sharing the recording and the slide decks after the meeting. So everyone have a great day, and thanks for joining.
Thanks, everybody.
Yeah.
Cheers.